Are you looking to invest into the booming India economy while trying to minimize the risk in your portfolio? What if I told you that there is a way to generate stable long-term returns in the market by investing in large cap companies? So welcome back investors. Today we are going to talk about the potential of investing into the large cap stocks and introduce to you our new portfolio, which is the Wright Titan portfolio, which allocates to large cap companies and can become a large portion of anybody's core portfolio. So let's start with the basics. What are large caps? Large caps technically are companies that have a market capitalization of more than 20,000 crores. These are leaders of their industries, having grown across the years, and because of the sheer size and diversification of their businesses, they end up being relatively stable and reliable. Now you must be wondering, why are large caps known to be stable? So large caps are stocks that have been there for decades. They have seen multiple business cycles, have been through various ups and downs, and have withstood many volatile times. Large caps provides additional benefits over their small and mid cap peers as well. So large cap stocks, you would see, typically end up paying regular dividends. So if you look at stocks like HUL and ITC, you would have seen that these stocks give you very regular dividends. So along with the price appreciation, they are giving you additional potential returns through their dividend income. On top of that, large caps can be a strong and steady element in your portfolio. So in times of market turbulence, you would see that your large cap allocation ends up being relatively more stable. So with this stable element in your portfolio, you can allocate smaller sums of capitals to even riskier strategies, knowing that a majority of your portfolio is protected by these large cap stocks. Now furthermore, large caps can also add a lot of diversification into your portfolio. Now what do I mean by that? See, large cap stocks have been there in the market for decades, and they typically would be involved in multiple businesses. So if you look at a stock like Reliance, it does oil and gas, it does telecommunication, it does finance, and so much more. So with one stock, you're getting a very diversified exposure across sectors. So including these large cap stocks in your portfolio, you can get that diversification benefit in your portfolio as well. Now let's try to understand how have large caps done across different cycles. So if you look at the performance of large, mid and small caps across different scenarios, you would see that the return patterns of these stocks end up being consistent across time. So now we're going to study the return patterns of large caps across few chosen scenarios. So first, let's look at the 2008 financial crisis. 2000 financial crisis was a big event in the market when there was widespread panic and a lot of selling across the board. But in this crisis, you would have seen some very interesting patterns. So while all the stocks fell, you would have seen that the small cap stocks ended up correcting close to 70-75% and recovered in 2009. But the large cap stocks only corrected around 40-50% on average and end up generating an alpha over the broader market. So in a crisis situation like 2008, large caps would have been a very, very organic cushion. Now another time when large caps really shone was the 2018-19 market. In 2018 and 19, certain regulations came out in the market, due to which small and mid caps saw a lot of selling. So you saw small caps correcting more than 25%, mid caps correcting widely, but large caps ended up giving a very good positive performance. So that was one time period when large caps really shone when there was stress in the broader market. Now looking at a recent example, during the 2020 crash, when the market again corrected deeply, you would have seen the large caps corrected way lesser in comparison to the broader market. Certain small cap stocks ended up correcting almost 50-60%, whereas the large cap index did not correct that much. And the stability and the reliance of large caps ended up playing a role there. And now in 2024, we are seeing those patterns repeat. In 2024, large caps have again started doing better than the small and mid caps. The broader market has seen correction, whereas the large caps have stayed steady. And in this market, almost 67% of large cap mutual funds have ended up doing better than the small and mid cap funds. You would have seen funds like the Quant Large Cap Fund, the BNP Paribas Large Cap Fund, and the Taurus Large Cap Funds giving more than double-digit returns in this period. So while these investments might not give you explosive and overnight returns, they will give you very steady capital appreciation and long-term growth, making them a very critical part of your investment portfolio. Now, why do you think this is the right time to invest into large caps? So if you consider the long-term performance of large cap portfolios, you would see that they have consistently been extremely reliable, lower risk compared to the broader market, and have ended up giving almost 13 to 15% CAGR returns. So if you look at the large cap index itself, you would see it has given a 13% CAGR across all history. Obviously, past performance does not guarantee future performance, but it gives us a reliable sense on what we can expect from the large cap index. Let's talk about what are some of the more reasons to invest into large caps right now. So number one, India's economy is rapidly expanding and large caps end up gaining a lot when there is a lot of interest in the country. You would see various sectors like the banking, infrastructure, IT, expand a lot in the next few years, and large caps will stand to gain a lot in that growth. Take the infrastructure sector as an example. According to an EY report, India's infrastructure is going to grow up to a size of $1.4 trillion by 2029. And think of that scale. So many roads, power projects, airports, and so many manufacturing facilities will have to be developed, and that is where these large companies will play a significant role. The government initiatives like the Make in India program are also boosting large caps across different manufacturing and infrastructure segments. When these schemes are announced, established businesses end up gaining a lot of traction, and there is also a lot of foreign investment that comes into large caps. And with elections around the corner, we expect the infrastructure and manufacturing segment to again gain a boost. Now, another advantage of large cap stocks is their liquidity. These companies have so many stocks that are very actively traded in the market, so you can very easily buy and sell these stocks without having the illiquidity constraints that some of the smaller stocks can have. Now also, the reputation of large caps give them a sense of familiarity. People know of these stocks and they end up becoming a source of diversification and allocation for a large set of investors. Now let's look at our Wright Titan portfolio and why it is made for you. We built the Wright Titan portfolio to specifically take advantage of the large cap opportunity. Wright Titan includes stocks selected from the top 200 universe on the Nifty. You would see mostly larger stocks in this portfolio. We use our unique blend of factor investing and risk management to create this robust portfolio. We are selecting stocks not just based on any trend metric, but we are combining the high quality and the volatility metrics of these stocks to create a much more consistent and reliable portfolio. This is a 20 to 25 stock portfolio with high growth potential, which could be an ideal portfolio for a whole wide range of investors. This portfolio is also highly diversified with a lot of strict constraints on sector allocation and stock allocation. We use a regime model that tries to forecast risk in the market using our proprietary AI technology, basis of which we sort of modulate the risk in the portfolio depending on the market condition. And we have another layer of systematic deallocation in place with this strategy, where if we see significant correction in the market, we move slightly to cash to protect your risk. Wright Titan can be the ideal portfolio for everyone. If you are in a mature stage of your life, nearing retirement, you are looking at much steadier returns, you don't want to take very high risk, and Wright Titan can be your significant equity allocation. If you are new to investing and you don't want to take a lot of high risk in the beginning, you could start by allocating to these high quality large cap names and build your portfolio from there. Now, even if you have a very high risk profile, you should have significant portion of your portfolio allocated to a much more stable portfolio. So while you might be doing momentum investing with a portion of your portfolio, even larger portion of your portfolio could go to a much more stable large cap portfolio like Wright Titan. Now another important question, how much of your portfolio can you allocate to large cap stocks? So if you look at various financial advisors, they typically advise that your allocation across different stocks should be a function of your risk tolerance and your risk appetite. But typically people advise your large cap stocks to have around 50 to 80% of your allocation. Now let's look at the current allocation of the Wright Titan portfolio. So our current allocation is diversified across a whole range of sectors. You have consumer stocks, you have automobile, you have engineering, airlines, pharmaceuticals, and so much more. Let's try to understand what is the potential of these different sectors in this portfolio. So we have electrical equipment and engineering stocks as part of the portfolio. These are the stocks that gain a lot from the long-term growth potential in the country. With long-term government contracts and the boost in infrastructure segment in the country, these stocks have a great path ahead for them. Next, we have the automobile segment as part of this portfolio. Automobile stocks end up being cyclical, so they gain more in times of growth. But recently, we are seeing a huge boost in the EV economy, and so many of these deals are happening, which give this sector a huge potential. We also have pharmaceutical stocks as part of the portfolio. Pharma stocks end up being defensive stocks in the market. What that means is that they are relatively stable in any sort of economic crisis or volatility in the market. So allocation to these stocks will provide a lot of cushion to this portfolio. Finally, we have a lot of these consumer stocks as part of the portfolio. Consumer stocks are typically counter-cyclical. Even if there is any sort of downturn, the consumption will not stop. And these stocks end up being relatively stable even in any sort of market scenario. Apart from these sectors, we have so many more allocation. We have so many interesting industries across the defensive as well as the growth side of things. We believe this strategic allocation across defensive sectors that protect in times of volatility and the growth sectors which end up doing great in times of economic upswings provides a very good mix of stocks to have in your portfolio. And with this balanced mix of stocks, we expect very steady long-term growth from this portfolio. So if large cap investing aligns with your goal and you want to mix our expertise with the benefits of large cap investing, I think this would be a great portfolio for you. We have crafted a very good mix of risk and rewards to come up with this portfolio which can give you greater long-term growth potential with a sense of stability. At Wright Research, we are committed to help you in your investing journey and make your goals achievable. If you liked this video, please do hit the like button, subscribe to our channel, and please do write in the comments what you would like us to talk about next. Till then, happy investing, and we'll see you in the next video.